Okay, so welcome to financial accounting revision. Today we want to look at partnership, and more specifically where partnership is closing and we have the realization account being prepared. So I just want to provide you guidance because this is an area where the examiner may want to test you in the coming exams. So they're telling us that Wanda, Kalule, and Mwambu are partners that are trading as wafanya kazi traders, and they're exporting cereals to South Sudan. Their profit or loss sharing ratio is 4:1 to 3 respectively. Due to insecurity in South Sudan, the partners have decided to dissolve the partnership. The following are their statement of financial position as at 31st December 2017. And this is the time before, definitely before they wind up. So we have land and building, plant and machinery, motor vehicle, inventory, trade receivables, provision for bad debts right there. We have capital accounts for the respective partners. There are 3. We also have their current accounts. So if you remember yesterday, we say that these partnerships that have the current account hold what we call a fixed capital. Basically, they use the fixed capital method, where the capital account specifically records the capital contribution and any other elements of partners between the partners and the partnership are recorded in the current account. So, and we also say that it can also be a fluctuating capital account where we don't have the current account. They said the fluctuating can also be called floating. Sometimes they can call it a floating capital method. So we have the trade payables. We have a loan from Wanda, who is one of the partners. And then we proceed to, they tell us that assets were realized as follows. We have land and building, we have plant and machinery, we have inventory. They're telling us that Wanda took over the motor vehicle that costs 14 million as part settlement of his loan. We have dissolution costs. They're telling us that accounts receivable were factored at 23.55. Well, Wanda took over 10 million of accounts payable and the balance was paid off, less 10% discount. And then Kalule could only manage to meet half of his deficiency before he became insolvent. So they're telling us that prepare for wafanyakazi traders as of 31st December 2017, a realization account, a bank account, a partner's capital account, and this time they want us to draw this in a columnar format. They want us to do a loan account as well as a payables account. So as we can see, realization account only comes in when partners are closing off, are winding up their partnership. So I usually call it more, it's more of an account where it's like a disposal account. It's like a partnership disposal account where we basically dispose of our assets and look at other details of the winding up. So one of the things that we know every time when you are writing off, okay, when you are winding up, means you have to write off your assets. So we usually write off our assets to the realization account. That is basically what we usually do when it comes to realization. We basically write it off to the realization account. So in this case, it's the same story because we have this partnership winding up and then we have assets. So the first thing that we look at are actually our assets. Let me just try to see if I can find, I try to share something. I just try to share with you some notes shortly here on the WhatsApp group, so it can help you somehow. Okay, so when it comes to winding up and where we have the realization account coming through, and then we have to transfer assets there, we have what we call steps that we do follow in the dissolution of partnership. So I've just shared the handout there on the WhatsApp group. When you look at page 12 of that handout, it has our steps for winding up of a partnership. And usually our first step is assets and liabilities are transferred to the realization account. Assets and liabilities are usually transferred to the realization account. And what we do in transferring our assets to the realization account, we basically, because assets have a normal debit balance. So when we are transferring assets to the realization account, what we basically do is we credit our assets. So we shall credit our assets and debit definitely our realization account. And we do that for all the individual assets. Realization account. So that is as simple as what we do there. Now, as we can see, this question has asked us to, because it is asking us to draw up the realization account. They're not asking us to draw the asset account, but they want us to draw the realization account. So like I said, our goal is to transfer these assets as we have them: land and building, plant and machinery, motor vehicle, and so on. So that is the first thing that we hope to actually do when it comes to this. Now, we know very well that if, for example, if we have a case in example, we have land and building, and land and building is 79 million, but now it's 79,000 because of the degree of precision. So the double entry here will be you crediting definitely your land account with the 79 million is definitely million, because the other side, they have a degree of precision. This is how it will basically be. So your realization account, you're going to see it this way. If you have your realization account drawn up, which I'll just try to show you how to go after this. So we shall draw it as our T account, definitely to have the debit side, and it also have the credit side of it, okay? So as we can see here, like I said, in this, they didn't ask us for the asset account, so we don't have to draw them. We don't have to draw them. If you do this, then you have already been able to show what exactly you're going to do. So our main focus is the realization account, because that is what the examiner wants to see. So as we can see here, as we credit land, we are debiting the realization account. So you're expected to be able to bring land here in this account. and give it a value. So in this case, land is 79,000. So I'll just do this. Like I said, I can say these amounts are in UJEX, thousands. So you can have your land right here, and you proceed again to the rest of the assets. Plant and machinery, you also bring it into the account. You can do this double entry to demonstrate, but definitely this is being, as we credit our plant and machinery, we are debiting our realization account. You get to realize that when we are dealing with realization account, you're basically closing off the assets because you no longer have those assets in place because you're basically writing them off. So they will no longer be in your books of accounts. So that is very important to realize. Now we get, I think yesterday when we were looking at revaluation, you got to see that in that case, we didn't basically write off the assets because the partnership was continuing. All we did was to add the revalued amount difference. Basically, if we had an asset at 10,000, we just add the revaluation gain of 2,000 and we're able to get the new value of the asset. But in this case, the assets are being written off to zero because the partnership no longer exists. And the realization account, just the goal is for us to determine a profit or loss on realization. Because at the end of the day, it's from that the partners are able to share the proceeds of the winding up of the partnership. Okay, so that is basically what will happen. All right. Sorry, my PC is trying to freeze somehow. But I hope you can get the point. Let me just try to see. Just give me a moment. I tried just to close some programs here that are making my PC freeze. Yeah, so I was just trying to explain about the aspect of realization before my PC did go into freezing. I was trying to say that when we are looking at realization account, our intention is to write off the assets. And in writing off the assets, write the assets to the realization account. And I was trying to basically demonstrate that within the Excel and how we can be able to pick on each of the assets. So I tried to do a demonstration for land and building. So proceed as well for our motor vehicles to also transfer them to the realization account. So all assets are supposed to be transferred. So we do land, we do plant, machinery, we do motor vehicle the same way. We also do inventory. Then we also do trade receivable. What we don't transfer is cash. The only asset that we leave out is cash. Now, not only that, after the assets, we also transfer the liabilities. So we shall also come and transfer the liabilities as they are. So you can see that in this question, we didn't have cash in the assets. We rather only have bank, which bank is actually a liability. So here we had a drawing, which is a liability in its own. So we wouldn't transfer this as a liability. We would only look at these two liabilities. That's what it would do. And then after that, let me see if this has resolved. Okay, so after the liabilities, one of the things that we're also going to do is to each partner's current account is cleared to his capital account. So whatever we are seeing here in the current accounts, we have to clear it to the capital account. Means when I say clear means that we close off the current accounts as well to the capital account. And then after we have done that, now we go ahead to sell the assets. Now these assets that we are seeing in the balance sheet here, when you come to the additional information, they give you how much you actually sold the assets. So what you sold the assets will basically be what will be recorded on the other side of your realization account. So good, it has been able to open up again. So this is what I was trying to tell you. So plant and machinery, we go ahead to pick as well any other inventory. You bring your inventory. Oh, we didn't take the wrong figure. It's not 28. It's the one up. It's this one that we are supposed to take. Suppose take it at 41, then the trade receivables as well. So you're seeing how we are doing the transfers. And like we said, we basically do, we credit the asset and debit the realization. That is if we are transferring assets. But if we are doing the liability, then we would debit our liabilities and credit our so-called realization account. So that is very important for you to clearly note, okay? So for our case here, you get to realize that we have some liabilities as well. So we have to also look at those liabilities as well. We have accounts payable. And then we also have the loan that is coming from one of the partners. But one thing that you need to understand is this information is very important. The additional information before you can make some of the decisions. For example, in this case, we can see they're telling us that one that took over a motor vehicle at 14 million as part settlement of the loan. So we had the loan of 15 and somebody took a motor vehicle 15. So ideally there is 1 million that's remaining, but we're going to see how to cater for that. We also have the dissolution expenses. Now the dissolution expenses, that is the amount of money that we pay maybe the accounting firm or whatever entity that helps us to dissolve, okay? So we are going to see how this is also factored in. We also have accounts receivable, which they are saying these were factored at 23.55, well, one that took over shillings 10 million of accounts payable. So the accounts payable were actually also taken over. So it means that the partner will pay these on behalf of the partnership later on. And then they're telling us the balance was paid off at 10% discount. And then they're telling us Carole could only manage to meet half of his deficiency before he became. And with this, we are also going to appreciate this so-called Ghana versus Murray as the aspect of accounting for cases where one of the partner goes bankrupt or is unable to pay his deficiency. So that is one of the things that we have to look at. So yeah, we can try to do this as a number. Now we have transferred the assets because we have transferred the land. We have plant and machinery. We have inventory. We have our trade receivables. Now, one of the things that we also need to look at is when you look at your balance sheet, which we have information here. When you look here, we have this provision for bad debts. Now, this provision for bad debts, we know very well from the treatment of provision for bad debts that provision for bad debts reduce your accounts receivable. So this provision for bad debts, ideally, them being here, if we are taking them into our realization account, we will credit them because just as we're seeing the trade receivables being debited, this will be on the credit side because ideally they would affect our these trade receivables if they are negatively, if they are put on the opposite side. So our provisions for them are transferred and are included here. Some people may choose to only transfer the net trade receivables, which may give you a very similar answer, but for matters of presentation, you want to make sure that whatever information you have, you're showing the examiner how you actually transferring it. So that is one of the things. So after we have transferred these assets, I also say that we have to take into consideration what are the proceeds from these assets. When they say that these assets were realized as follows, means these assets were sold off and these were the proceeds for these assets. Now, in the same way, one of the things that I also usually encourage students is right now, one of the things that they have also asked us here is prepare a bank account and prepare the partner's capital account and prepare a loan account and prepare a payables account. So anything that affects us, anything that we work out, we are working with, you can be able to open up some of these accounts so that as you get to something that goes to maybe a realization account and also goes to the bank account, you can always put it directly without having to first finish one account and then come back to do the other account. So I'll just put my bank account there. You make sure you leave enough space so that at the end of the day, you can be able to put all the other information in. So I'll just try to do this. So because we are selling off these assets, you get to realize that we are going to receive some money, and this money is receipted through the bank account. This money is receipted through the bank account. Now, this question, you get to realize that they didn't give us a cash account. Sometimes the examiner can clearly bring it out that all payments are through the bank account. I don't think here they brought it up, but by the fact that we don't have a cash account here, we want to work with the bank. And in most cases, for most of these wind-ups, we usually work with the bank. So this bank itself has a balance brought down of 4,000. Even before you do anything on the bank account, you have a balance brought forward of 4,000. But in this time, this balance brought forward is actually on the credit side because it's a bank overdraft. So you need to be able to pick this and take it to the bank account as the first item that you record there. So you come here and say balance brought down of 4,000. So you can also include the degree of precision. These amounts are in UJEX 1,000. So we have our that. So I want to show you how we now sell off these assets and what is the double entry. Now, since we have already transferred the values of, let's say, land and building from the land and building account now to the realization account, that's where they sit. When we sell off these assets, the proceeds should go through the realization account. So the double entry for realizing these assets will be to debit bank because cash is, okay, cash is coming in, bank, it's through the bank, okay? Money is coming in through the bank, with debiting by bank, and we credit our realization with this amount of land and building. So what will happen is when you come to your bank account, you come and debit. You come and debit with your 90,000 because there is a realization. You can even say this is it's realization because it's the alternative account. Realization from land and building. So the next thing is to look at now, as you put it here, this again will actually go to your realization account. But in this case, it will be credited because we are debiting bank as we credit here. So we have our 90,000 here. So we have our bank, and this is coming from this realization of land and building. So you have something like this. So you do the same thing for plant and machinery. When you look at the question, plant and machinery was realized at 45. So you'll be able to bring that up. So you just come to here, put plant and machinery, put 45 here and say realization. Plant and machinery, we have that 45. And have inventory. All right, so the same thing with plant and machinery, you still transfer this to here. So I'll come here, but this I'll call it bank because it's the alternative account, bank, plant and machinery. So I'll do the same thing for inventory. So you put it here. So what is happening here, like I've said, we are selling off these assets. So this is the money that we are getting from these assets. That's why we are debiting our bank and crediting the realization account, not the asset account, because we have already transferred the assets from the asset account to the realization account. So that's why we are doing every transaction from here. So that is what we have with our assets that have been realized. Now, let's see if I put this one here up. I need to take this as well. So that is what we basically do have for our assets. Now, after we have done that, we now look at other aspects that we are going to recognize in the realization account. Now, we have the resolution expenses. We can take care of those because there is no much logic that you have to use on these dissolution expenses. The dissolution expenses, these ones, you bring them here to your realization account. Now, the double entry for the resolution expenses, you know, resolution expenses, okay, it's an expense itself, but we are paying this money. So because we are paying this money, we credit our bank. We credit our bank. Basically, our bank will be credited with this 3.5. Which we shall say 3,500. And as you credit them here, you're supposed to debit them in the realization account. You're supposed to credit them in the realization account. That is one of the things that we do when it comes to the so-called resolution expenses. Okay. Now, after we have taken into consideration our resolution expenses within our realization account, I want us to now look at the aspects of whatever was taken over, and then also look at more of, because one of the things that they tell us when you get to the text here, they tell us that Wanda took over the motor vehicle at 14 million as a part settlement of his loan. Now, the way Wanda took over is more of like, instead of us selling this out, Wanda took over this motor vehicle, okay? Now, in our realization account, just like we credited the sale of the land and building, even the takeover of this motor vehicle by Wanda, we shall credit it, because that is how this motor vehicle has been realized. But we shall realize it at still at 14 million at which Wanda took it. So we shall take it to our realization account at that value. So you just come here. It is 14 million. So this is, I'll do 14,000. And I will say motor vehicle taken over, taken by Wanda. So that is what we basically do. But this, yours is to ask yourself, what will be the double entry for this? As we are seeing it being coming here, this 14 million being created in our realization account, what would be the double entry for this? Now, Wanda is a partner. And because Wanda is a partner, means that we have to look at his transactions also through the partner accounts, okay? Because we have a partner account for Wanda, but also one of the other things, remember Wanda took over this because he had a loan that he had given the organization. When you come here, we have a loan from Wanda, which is standing at 15 million. Now, one of the accounts that we are drawing up is the loans account. And remember, we only have one loan, which is the loan from Wanda. So what we shall basically do is we shall go ahead to draw up the account for loan from Wanda to recognize this payment. It's more of like we are paying him. We're not paying him cash, but whatever he takes is more of to pay himself off what he demands, the partnership. So that is what we shall try to take into consideration. Remember, loans have a normal credit balance. So this is loan from Wanda account. Now, loans have a normal credit balance. So remember, they have told us that the loan is worth how much? Is worth 15. So you bring this balance brought down. You come to your here and say balance brought down is 15 million, 15,000. Set these values, shillings, 1,000. So this is balance as per the balance sheet. So balance brought down. So before we pay anything, this is how the loan account looks like. Now, when Wanda takes over this motor vehicle, as we credit it here, this motor vehicle 14 million, we come and debit it in the loans account because it is settling the loan. Remember, whenever we settle the loan, we debit it because the liability is decreasing. So the liability is decreasing by how much? By the same amount, which is 14. So I'll just come here and put this thing here, and I'll say realization of motor vehicle, and I'll just put in bracket taken by Wanda. So you're able to put the 14 million of what Wanda took, okay? But remember, the 14 million was not in full settlement of how much Wanda was demanding us. They told us that this was as part settlement of his loan. So what means is the 1 million remained as outstanding, because when you balance off this account, you get your 15,000 here, and you have a balance of how much? A balance of 1,000, okay? You get a balance of 1,000. Now this balance, we are going to see how we are going to settle it, because one of the things that happens when we are realizing, when we through the realization process, if you are to look at what I gave as some of the steps, we have payments. We basically pay off liabilities. But if at all we have liabilities that are taken over by the partners, okay, like apart from the liabilities that are taken over from the partners, because we have, in this case, it's a liability from the partner himself. So we're going to see how that happens. So let's first look at, we've seen how this goes to the realization account. We've also seen how this also goes to the realization account. Let's also look at this. Now, this also has one of the things, I think they asked us for payables account, so they didn't ask us for receivables account. So they're telling us that accounts receivables were factored. Now, factoring is more of a receivable management system where you accept a lower amount for your for whatever you have as a receivable. You demand somebody and somebody gives you an amount less, and for them, they go after that person to pay them. So it's the same thing here that they are saying, that our accounts receivables that we are seeing here, which are 25,000, were realized at 23.55 million. They were realized at 23.55 million. Now that 23.55 million is money that has been paid. So we know that the double entry for that will go through the bank by debiting the bank. But since we had transferred our receivables, because if you remember, we transferred our receivables to where? To our realization account, then we'll take into consideration to make sure that we are also, as we debit our bank to recognize the realization of our accounts receivables. Realization, can say factored, factoring of receivables. So these receivables, from what they have told us, the receivables were factored at how much? At 23.55. So I say that is money that is coming through. So what you're doing here is 23 this, just multiply this by 1,000, and it will be about something like that. 20, it will be 23,550. That is basically what we have. So bank is receiving. As you do this, you come to recognize that into the realization account. But definitely, of course, here we shall not call it again realization in the realization account, but this will be bank, because it's the alternative account which is coming in here. But we also know that these were also not paid in full. Okay. They're telling us that these were factored. Well, okay, these were factored 23. Well, Wanda took over 10 million and the balance was paid less. So the receivables basically end here. They basically end there because they were 25 and they were factored at that value. So this comment is actually for accounts payables. And one of the accounts that we're also interested in is the accounts payable. So like I said, it's important that you can draw up these accounts as well, so that as you enter information to do with payables, the other side, you can also be able to enter it in your payables account. So I'll also have my payables account. So these were the payables that the partners had before dissolution. Now liabilities are supposed to be settled. But in this case, the liabilities were taken over by the partner. Which partner is called Wanda. Now, if that is the case, what we have to basically do is remember, we have a payables and payables have a normal credit balance. So the first thing you're supposed to basically do in the payables is balance brought down is this value. So you do your balance brought down. Which is that value. Now, they are telling us that these liabilities were taken over by the partner. Now we have, when you look at, there's this handout that I shared with you, we have something here, step external liabilities. Now, whenever external liabilities are taken over by the partner, we basically would debit our realization and credit the partner's current account. So more like the partner is going to settle on our behalf. Okay, I thought somebody was saying something. So since these are being settled by the partner, remember, we have to reduce our payables account. When payables are reducing, we rather do what? We rather, we debit them. So in this case, we shall come to our payables account. Now we are not paying by cash, okay? Rather, this is being settled by the partner. So we are going to debit. But what would we debit? We debit with the partner capital account. Remember, we say that whenever we have payables taken over by the partner in one way or the other, their capital account is affected. So I'll just put here capital and I'll put how much the payables are that this partner is taking on. When you look at what we've been given here, they are telling us that the partner takes over 10 million. So we shall try to credit our here by 10 million, which is 10,000. This is UJX 1,000. So it is 10,000 that the partner takes. And then they tell us that the balance was paid off less a 10% discount. Now, when a partner takes on accounts payable, means like these accounts payables will be later paid off by this partner, maybe at their due date. That is what exactly happens. So you're basically taking on an obligation to pay it back on behalf of the partner. So it's telling us the balance, because if it's 23.55 and they remove 10 million, you remain with 13.55. So 13.55 was paid less 10% discount. So we are going to account for that. 13.55. Okay, I hope I've gotten it rightly. Let's see. So the obligation is 23,500 and we paid 10,000. So the difference to this is 13,500. So they're telling us that this was paid less 10% discount. So this is the remaining obligation. This is this 10% discount. So 0.1, 10% is 0.1 of this. It is that value. 1350 is the value, and the amount paid through bank will be just basically the 90%, or you can just say this minus the discount, which is 12,150. So this 12,150. Now the double entry for such a transaction, remember, we're crediting our bank because bank is losing 12,150. You also, you're going, remember, you have your accounts payable. Now your accounts payables are going to get a net effect. Now, whenever you are paying off accounts payable with a discount involved, there's an income because this is discount received. So there's an income which I'll credit. I'm going to credit my discount received of 1350. Sorry, it is supposed to be this. So this, the total of all this is supposed to be debited because my accounts payable, I'm supposed to debit it by 13,500 so that my account balances off. So my accounts payable will be debited with the total, which is 13,500 because I have to close it off. So partly is being paid, partly is the discount. So I've not been asked to drop the discount account, so I'll not mind much. So what I want is the bank account. So I'll just pick this 1,250 and come here to my bank account. Since we are paying, I'll say accounts payable. So I'll have my 10, what I am paying, which is 12,150. 12,150. So as it is there, I want to come here, recognize, say bank. I can even break it down, 150. And then the other one is a discount received. As we credit it here on the discount received, it's being debited here of 1,350. So you can see that this one balances off because you get 23 that, this is also 23 that. So this account is balanced off. And remember, one of the things that we don't have balance brought down here because the partnership is winding up. So these accounts are usually closed off, as we can see when it comes to the payables account. So once we have done that, I'll just come back to the text and see what we need to take. So we've tried to take into consideration this. Now, what we are remaining with, one of the things that you need to realize is there is an account that we've not balanced off. This balanced off now, the loans account. Now, the loans account, what we are going to basically do is sometimes you can transfer this to the capital account, okay? Because it's an obligation that's existing, or we can pay off this through the bank, okay? And by paying off through the bank we shall debit the loan account and credit our bank. So what will happen here is this balance, which is 1,000, will be paid through the bank. So bank 1,000, so you put it here, and then you come and credit your bank account here. You say balance on loan. To Wanda. It is 1,000. So this account you also balance off, because this side you have 15,000, the other side you also have 15,000. Like so. So what we've not balanced off now, bank account is we first leave it. What we want to look at is our our realization account, and just make sure that we have taken into consideration whatever is supposed to appear within our realization account. Now, one of the things that we need to realize is that we had, since we don't have the discount account here, this credit of the discount, we shall pass it through the realization account. So we shall bring this 1,3 this right here. So the discount received of 1,350 will be factored in our realization account. That is one of the things that we're supposed to take into consideration there. So we have tried to take into consideration. There's nothing else there that we need to. So if that is all that we have, then we are supposed to go ahead to balance off our account. If at all there is, I don't know if there is from your analysis, if there's anything that we have not included here, because at least we included land and building, included plant and machinery, included inventory. Okay, I think what we had not included is actually this. I think we didn't transfer this motor vehicle when we are trying to copy the information. I think we didn't transfer this motor vehicle in our realization. Remember, the concept says we should transfer all the assets. So this 16,000, we had left it out here. Okay. So you try to analyze as you look at your question paper and see what you basically do have. So if all the information is there from your analysis, you come and add up this side and the other side. Now the side that gives you a higher amount, it dictates basically what you have as your total, and then you create your balances. What would be the difference? Now, as we can see, this side is 229,500 and this side is 203,900 for whatever we have input. Now, the difference between these two sides, this minus this, is basically what you would call a profit or loss on revaluation. Any difference between these two values is either profit or loss. Now, it is a profit if at all this side was higher than this side. Why? Because whatever we sold, these were the proceeds. So if the proceeds are higher than the actual value of the assets, then you have a profit. But if the proceeds are lower than the value of your assets, then you'll have a loss. Now, in this case, we are seeing that our proceeds are lower than what we had as our value of assets, because this side is 229, this side is 229, this side is 203. So in this case, we'll have a loss on revaluation. No, sorry, on realization. Shall have a loss on realization. Now, this loss on realization is shared among the partners on the sharing ratio, on their last sharing ratio. Now, the difference between these we have found to be 25,600. So our partners, when you look at what they gave us, they told us that our partners were sharing, the profit or loss sharing ratio is 4:3:1. And this is for Wanda, Kalule, and Mwambo. So I'll just transfer these guys' names here and then share the respective losses. So Wanda, Kalule, and Mwambo. So this is what we basically do have. So remember they have told us that they're sharing a ratio of 4:3:1. So this 4:3:1 is what will be the profit sharing ratio of this value. So it is 4:3:1. So the total ratio definitely is 8, because it's 4 plus 0 plus 3. Okay, 4 plus 1 plus 3. So for me to get this will be 4 divided by 8 times 25,600. I hope you get what I'm doing. So 4 out of 8, which is the ratio for Wanda, will give me 12,800. I'll do the same thing for Kalule, and this will be 1 divided by 8 times 25,600, which gives me 3,200. And then for Mwambo will be 3 divided by 8 times 25,600, which gives me 9,600. So this total will now be updated. When you update this total, it will be now 20. It will now be able to balance off. Now, of course, this is a realization account, and this needs to balance off. Now, as you balance off your realization account, these values, these losses, if it were profits, it would be this side, like I said. Now, these losses are supposed to be transferred to the partner capital account. Now, in this case, the examiner asked us to also draw up the capital account. So we are going to draw up our capital account accordingly. And I want us to use columnar format. So every partner will have a column of their own, just like the way we did the other time. So I'll just create a capital account. So we have, remember, we have 3 partners. That is Kalule, Wanda, and Mule. So I'm going to create for them different columns down in the capital account. So when you come down here, you have column for Kalule, column for Wanda. And remember, capital account will have definitely it's going to have, we'll have a detail, and then we'll have a detail here, details, and this same thing will also be at this other side. I'm trying to make it like this so that you can see what I'm going to do. So this will be my debit and this will be my credit. My partner's capital account. So if this is what I have, now remember what I'm going to do. I'm going to transfer these values in the, as they are here, I'm supposed to transfer them to debit my capital account. Now, in this case, remember, before I even do that, I have to first get the balances into the capital account. We have current, but we have like balances that we need to put as our balances brought down in that account, these balances. So you can see we have one that has 15,000 as a positive balance. So I'll just come here. I'll say balance brought down. So one that has 15,000. Now we also see Carole has 24,500, but this one is a negative. Now Carole's balance is a debit balance. So for Carole, we shall not put it on the credit side, we shall put it this side. So we also have balance brought down. Under Carole, we shall put it here, 24,500. Very similar to this, we shall come here and pick for Mwambo, which is 11,000, which I also take 2 here. Like that. That is what I'll do for the balances. Okay. Now, after I've done the balances, now one of the things that we need to look at as well is from our, remember what I talked about earlier on, that whenever we have balances in the current account, oh, I picked, sorry, I'm supposed to pick these values. I think I've picked the current account. So allow me just change this. These are current accounts, they're not capital. These are the balances for the capital account. I'm going to comment on the balances for the current account. So these are all positive. Okay. These are all positive. I picked wrong values. So there you cancel and you write the right values. So these are all okay. So these are the balances brought down. I've just changed them because of this. These are the balances brought down. Now, one of the things that they told us that you transfer the current account balances to the capital account. Now, we shall no longer have the current account at the time of winding up. These balances are all transferred to our capital account. So what we are going to have here is you're going to have your current account. These are transfers from the current account. So whatever you have in the current account, 15,000, since it's a positive, remember current accounts and capital accounts are a bit similar. The current account also has a normal credit balance. So whenever you have it on the credit side, it will also be in the credit side on the capital account. So 15,000 right there. You also come here. Now I'll first pick for Mambo and then come and pick for the other. So Mambo is recorded there. Now, like I said, when you have something in credit, either it is a balance, if for example, this was in credit, to be put on the debit side, if it was in a bracket. The same thing happens here. If our current account shows a 24,500 for Wanda in bracket, what I'll basically do for Karule, I'll just come here and say current account still, and I'll record this value in here, 24,500. Okay, I'll record it in that column. That is what I'm going to basically do. Now, remember we had some values in where? Here, in the realization. So the next thing I'm going to do is to take into consideration what we had as terms of share of the realization loss. So these values, so loss on realization is supposed to be put here. Loss of realization. So I'll come and put these values in the respective columns of each of the partners. Put it there. Put it there. In case it was a profit on realization, definitely here it will be on the debit side, and it means that when you're transferring it to the capital account, to be also on the credit side. Remember, in the capital account or the current account, whatever benefits the partners is on this other side. Whatever is more of a payment, an obligation, whatever it is usually on this other side. So that is what we put there. Now, in the same way, one of the things that you also need to take into consideration is when you look at our additional information. Okay, before even we look at additional information, when we're trying to do, we're trying to take into consideration, I think it was the motor vehicle. Yes, I think it was the motor vehicle somewhere. Motor vehicle. Okay, before the motor vehicle, remember this that we did where we said that we are debiting the payables account and putting capital in bracket Wanda. Now this, as it is debited here in the payables account, it is supposed to take into the capital account and credited. This 10,000. So this, you'll find it here also on the credit side. But remember, it is Wanda who took over, and the narration here will not be capital since this is a capital account. So these will be payables taken over. So the double entry will be completed here. As you debit them in the payables account, they are basically credited here. So that is one of the things that we look at. Now, the other thing that also need to look at is when you look at, we've taken into consideration the loss on realization. We have also transferred our capital account. Now there's something that they speak about here. Now they're telling us that Kaole could only manage to pay to meet half of his deficiency before he became solvent. Now they are telling us that something here that not apply the rule as per Ghana and Murray. Now you need to understand what the rule of Ghana and Murray basically says when it comes to solvents of partners. Does anyone on the call who is attending this live aware of this? So that maybe they could just state it for us, maybe just to see if some people have maybe already researched about this. Has anyone ever heard about the Ghana versus Murray rule? By any chance? So maybe just to quicken up this, Ghana versus Murray was a court rule. It was a case. And the case provides guidance for a case where one of the partners is insolvent. And the ruling was that if one of the partners become insolvent and is unable to pay the amount due to him, the amount not paid is a capital loss, which should be borne by the solvent partners. The person who cannot pay is called insolvent. So the solvent partners, the partners who are still okay financially, they share, they basically take over, they bear the so-called deficiency in the ratio of their capitals standing in the balance sheet on the date of the dissolution of the firm. Okay, so they share the deficiency using the profit sharing ratios at the balance sheet date at the time when the firm was being wound up. Now, when you look at our question here, they are telling us that Kaole could only meet half of his deficiency. Now, the first thing, even before you proceed, is to understand what is Kaole's deficiency and why even the deficiency coming through here. Now that you can best understand it when you look at our so-called capital account. Now I want to draw your attention when you come to the capital account here. If you've input all the information in this capital account, you're going to see that Wanda has more on the credits side. Let's just add up this and you see. You don't have to add this in the exam first find out. So we have 123,000. I'm just trying to add this up. And then we are seeing this Kaole has 20,000 and then Mambo has 73. Now, when you look at what they have on the debit side, Mambo has 9,600. Kaole has now a summation of all of this, which is 27. And then we have 12,800. Now, I want you to look critically here. Remember, capital has a normal what? Capital has a normal credit balance. So it means that any partner that has more on the debit side, any partner that has more on the debit side than on the credit side is actually not doing well. They are basically in negative when it comes to their balance, because remember, at this level is where partners are sharing, they are winding up. So there is that aspect of partners trying to look at what is standing on their capital balances at that time of winding up. So the deficiency that Kaole has is basically the difference between what we are seeing here and what we are seeing here. Okay? Because remember the other side, this other side, he has 27,700. This other side, all that he has is the 20,000, which is his capital. So the deficiency, we just try to calculate, is 27,700 minus 20,000. This is the deficiency. So the question is telling us that this gentleman is able to pay at least a half. So this times 50% is 3,850. So 3,850 is paid by Kaole, because that's what they're saying. So this definitely is paid through the bank. So it means that bank, when you come here, you come in your bank and recognize it and say bank Kaole payment for his deficiency, the 3,850. And then as you debit your bank here, you come and credit here. Remember these totals, I just told you that these totals just help us to determine the deficiency, but they're not supposed to be there. You only put the totals after you've fully balanced off your account. So there is bank, and this bank is by Kaole. For his deficiency, I'll record what he has paid, which is 3,850, under here. Now, the balance, which is the deficiency that is to be settled by other partners, is the same value, the other 50%. And the rule tells us that this is shared based on their profit sharing ratio at the time of the balance sheet date. Now, yours is to ask yourself, at the time of the balance sheet date, what was the profit sharing ratio? What is the profit sharing ratio? Now, one of the things that you get to realize is when you go look back to the question paper here, they gave us this profit sharing ratio. But this profit sharing ratio is for the partners as they are, okay? Now, you cannot use this profit sharing ratio because this includes even Kaole on it. So you cannot just say, let me share now 4:3. No. How you determine that profit sharing ratios is you come and look at the capital balances, the capital values that these guys have. So these guys have one that has 98, Mwambo has 62. We are closing our eyes on Kaole because these are now the solvent partners that are going to bear the obligation. So you basically have to now look at those two partners and look at their capital values and add them together. So I'll just bring Wanda, can just try to calculate this. So this is 98, that is Wanda. And then the other one is Kalule. No, Kalule we are leaving out is Mambo. Kalule has paid off his obligation, so he's insolvent. We are going to, now we have this. Now for us to determine the ratio, what we do is, the ratio for Wanda that we are going to use is, let's first get the total of their capital values. Summation of their capital values is this. Okay, 160. We can even add the 3 zeros that they have, so that we, since we are working off the presentation. So their total capital is 160 million. Now, if you have to get ratio for Wanda, will be basically, this is ratio. To share Karule's balance. It will be 98 million divided by 160 million. That will be the ratio in decimal places. For this one, it will be 62 divided by 160, like that. So this amount that we shall get, it will be basically, you just now multiply this times the 3,850. So it will be this times the 3,850 thousands. Remember, it has thousands on it. So it gets us 23,5,815, as you can see there. And then we have for this one, it is this times 3,850, same amount, which gives us 1,400. That when you add these two amounts, they should add to 3,850. So this is how they are going to share the deficiency for Karule. Now, these values are supposed to be brought to the capital account, because we are going to recognize the sharing. Just like the way Karule paid the 3,850, now his balance is being shared between these respective guys. So what we shall basically have is just come here, and we shall say share of Karule's deficiency so the deficiency is being shared between these two partners, and we've already gotten the values. So those values that we have, you come and now we're going to do two things. We debit and credit, okay, in the same account. So these values are going to be on the credit side, they are going to be in the same column as Karule paid the 3,850. So we're going to have, since design, we can try to round off this. This will be 23858.125. So 2358.125. I'm putting them in 1,000 since I'm working in thousands, and that reminds me to just include the degree of precision. Make sure you include it at any time when you remember. So that value is there. Then I also bring the other one, which is 1491. 1491.125. 875. You can round off, but let me first work the way they are. If you round off, this one will be actually, we can try to round off anyway. This will be 3358, and this one will be 1412. If you round off, you can choose to round off. So if this is what you have. So in the column of Carole, we shall have these two values, and partly one of it is for Wanda, and then the one bottom is for share of deficiency for Mwambo. So as you credit it here, you're supposed to debit it here as well. But now in this case, it will now be in the respective columns of the solvent partners. Remember, these partners are bearing this difference. So Wanda will have his share in his column here, and this guy will also have his share in this column, Mwambo, like that. Okay. Now, once you have shared the deficiency here at hand now, and you have also made sure that you have recorded everything in the bank account. So you now have to balance off. You have to balance off your capital account. And then you also have to clear, of course, basically we have, when it comes to these steps, I usually want to encourage you to read through that handout that I've shared, because it has the steps that can help you on what to do exactly. Now, we balance off the capital account, and definitely any partner that would have, again, a balance pays it through the bank account. But here we have seen Carole that does that. And then we close off our bank account as well. So in this case, when you come here, definitely after these partners have bared their balance, the balance of Carole, they will still remain with something as well. They still remain with some balances. So what is going to happen with those balances? Those balances are supposed to be paid through the bank account. So what is going to happen here? Let's try to balance off this account. Carole's account will balance off automatically because this side is 27, this side is also 27. So this is going to happen like this. I encourage you to find a question like this and you try out and see if you remember the concepts that we've just tried to look at. So I'm going to get the respective totals. So in most cases, this side is higher. So here we have 123,000. For that is the column of who? Of Wanda. We also, this one I say this one will have the same 27,700, which is definitely the same here as well. Then for Mwambo, when you add, you get 73,000. But then for Mwambo, this side, it's not the case. Like it is less than 73. So the difference, that difference is what we are supposed to be paid to them through the bank. Okay. So what would be now in this case, since the partnership is winding up, we don't have to have a balance carried down. So I'm going to have a bank, because these values are now going to be paid through the bank. So I'm going to have, for Mambo, let me get the difference here. This is 11. Let me just do this. You can do this on your calculator. So I get this value, then compare it with this. So I get this minus this. So it gets me about 61,908. So I'll get this 61,908 and bring it here. And bank like such. So this one will now get the total of 73, just like the other side. So I'll do the same thing also for this guy who Wanda. This side is 115 that. I'll just add up here. So this is 15. And I'm going to compare it with 123. So it gives me 2242. Is it? Sorry, let me try to do this. Does it give me that? Okay. Have I added up rightly? This is 1.5 that. And then you tell me if you're getting something similar on your calculator. Oh, this is it's not this. Sorry. This is supposed to be 120 that I'm subtracting from, because I want to get the difference for this column. So this gives me about 107,804. So when I bring this here under the column of Wanda, gives me that. So I should be able to get the 12 1 to 300, which gives me here. So I've balanced off, but remember here I've not put balance carried down. I've rather put bank. So as you put them here, I'll now come to my bank account. Remember, I'm going to pay these partners. These partners are going to share the balance that remains in the bank account. Okay. Now you're going to realize that when you balance off your bank, this is 190, and this side we have, let's see what we have this side. This side is 26 6 that. Let me just try to get the difference between these two values. Now you get 169,750. Now you're supposed to come here within here and put capital, because the capital account we are balancing off it through here. So capital for Wanda, and then capital for this other guy, Mambo. So these values as they are here, you transfer them. So one thing you get to realize is that the summation of this, it was the difference in the two sides. And even when you add these two sides now, when you add it here, you get to realize that it will be the same total that you actually get here. So your bank account is supposed not to have any balance brought down or balance carried down at all as well. Once you've transferred this from the capital accounts, it should be able to automatically balance off. And that's why you see we are getting, this is balancing off and this is also balancing off. So that is how you would wind up your partnership. Okay. Yeah. So to those that have followed this online, do we have any question on regards to what we have just done? If you have any, you can unmute and ask. Or you can use the chat box if you cannot speak. And if we have understood, I'll hope that I encourage you to look for a number of a similar caliber to try out and see if you can remember. The concepts remain the same. Like I said, you can use these as guiding steps, the ones that are in the handout that I've just shared with you. But the key takeaway for us is to understand that realization is more of like a disposal accounts. If you do, if you understand how depreciation, how we dispose of assets. In this case, we don't draw up a disposal account, but we rather use the realization account. And you have seen how we have transferred all these assets, and we've been able to recognize what we have received from them by crediting our our respective account here of realization. Then other proceeds, dissolution expenses are always debited. If in case a partner takes on a vehicle, you also have to credit it there. In case there is a loan, we have seen how it is brought up. We have seen how the bank account is done. We have seen the loan from Wanda and so on. We can see that here on realization, the examiner didn't require us to draw up the asset account. So when you draw up them, of course, you'll not be penalized, but they'll take a lot of your time. Okay, so it's very important that you understand what exactly the examiner is looking for. You don't have to complete a double entry for them, because the only what they are going to mark is this, and they're going to mark entries. Okay, they're going to mark entries, and just make sure that the entries are okay and you understand them. So that's what I can basically comment on this specifically. So I believe that right now you can distinguish between revaluation and realization, and where it can be applied when it comes to this. You can try to look out for numbers, similar numbers, and see how you can try to go through this. You can even get the same number. Don't look at the solution or go back in the recording. Just try it by yourself and see if you can be able to remember what we have done. Okay, if you've already done it, well and good, that is good. So I don't see any question in the chat box, and no one seems to have unmuted, so we can call it today a day. And on Thursday, tomorrow we shall not meet. I have another class, so Thursday we shall meet and look at the cash flow statement and some bit of inventory. I just want to comment on inventory as well on Thursday. So endeavor to attend. And also, in case between now and Thursday, in case you get any challenge, make sure that you share that on the WhatsApp group, not on my direct WhatsApp, but on the WhatsApp group. And then we can be able to look at that in the next class. The same thing for what has just been shared there. I'll try to look at that. In case you don't have any notes, please post it on the WhatsApp group. And in case you have some of these notes, please share with the rest of your colleagues so that they can also be, even if you have like the objectives, I think somebody was looking for the objectives. Let's share materials as much as we can so that we can all pass, okay? Yeah, for now, don't be on pressure. all you have to do is practice, okay? Get to examination papers, write down your answers, get your hand busy, make sure you have a working calculator, start practicing your calculator right now so that you can know where the buttons are, so that when you get the exam, you're not stranded. At least you should have a calculator, you should have a ruler before you go to the exam. That's very important. So ahead of the exam, have those things with you and make sure that you practice when using them. And time yourself also to manage your time as well, to make sure that you're not spending a lot of time on a number instead of being able to move to another number. Like I said, your aim on every question is to make sure that you're getting the quick marks. You don't have to balance off a question before you can even earn free marks on other questions. So first get the entries, draw up the respective accounts, and then come back and balance off and get those other respective marks, okay? Yeah. So I want to wish you well, and yeah, we'll link up on Thursday. Unless there's any other question, I would love to call this a day and we go and rest.